If Iran escalates, oil won't be the real problem. Liquidity will. And liquidity breaks before markets understand what's happening. When most people think about a conflict with Iran, they picture gas prices on the news, soaring overnight. That's the lightning. They're missing the thunder. The financial chain reaction that starts with energy but could end with a global credit freeze. Most investors will be watching gas prices. By the time they realize what's actually breaking, it'll be too late to reposition. Because in a liquidity event, repositioning requires something most investors won't have: cash. And in a real crisis, nobody hands you liquidity. You either already built it or you don't get it. To understand the trigger, you have to look inside Iran. The regime is sitting on a powder keg. Crippling inflation over 40% has decimated savings. The national currency has collapsed. Billions in capital are fleeing the country. A desperate regime makes markets nervous. But markets don't price desperation. They price disruption. And disruption doesn't need a declaration of war. It needs a choke point. And that disruption will almost certainly center on one place: the Strait of Hormuz. This 21-mile choke point carries roughly 20% of global petroleum. That's roughly 20 million barrels per day. No other shipping lane matters more. A closure doesn't require a blockade. A single drone attack or the threat of naval mines could cause shipping insurance to skyrocket, effectively freezing traffic. No company will risk a $500 million vessel in a live fire zone. This is the spark. Any action that shuts down the Strait of Hormuz will ignite the first domino. The moment the Strait of Hormuz is credibly threatened, the oil market won't just rise, it will break. Brent doesn't drift higher in a crisis. It gaps. You don't wake up to 4%. You wake up to $20 missing from equilibrium. This isn't just a number on a screen. This is an inflation shockwave that immediately hits the global economy. And that brings us to the central banks. For much of late 2025 and early 2026, the entire financial world has operated under the assumption that central banks were preparing to cut interest rates. Here's the trap. Markets are pricing rate cuts. An oil shock deletes that assumption overnight. Faced with a sudden inflation spike, their worst nightmare, they'd be trapped. The rate cuts the market expects would vanish. They'd be forced to hold rates higher for longer and maybe even start hiking again. Most investors think war means volatility. You're smarter than that. You know volatility isn't the danger. Funding stress is. Most people trade price. You're here to understand plumbing. That policy reversal from central banks creates a toxic 1-2 punch for businesses. First, their energy costs explode, hitting profit margins across every sector. Second, at that exact moment, their financing gets more expensive. This combination is an absolute margin killer. Profitable businesses see profits shrink. Marginal businesses are pushed into the red. And who's watching this with a magnifying glass? The banks. All their risk models start flashing red. And what do banks do when risk goes up? They de-risk. They pull back. They tighten lending standards and demand more collateral. The supply of credit, the lifeblood of business, starts to dry up. And here's where this stops being about companies and starts being about the system itself. Here's where most people stop thinking. They assume banks just tighten. No, they pull liquidity. This is the part of the story that rarely makes the headlines, but it's the true systemic risk. The trillions of dollars of goods that cross borders every year are financed by a complex system of short-term credit called trade finance. This whole system runs on two things: trust and the cheap, easy availability of short-term US dollars. Now let's connect this back. The banks are already nervous. Their risk aversion goes into overdrive. They start to hoard cash. And when banks hoard cash, the system doesn't slow, it snaps. The system begins to seize. Interbank lending tightens. Trade finance dries up. Dollar funding spikes. They stop trusting other banks. Why would a bank in New York extend credit to finance a shipment between two companies it knows little about in the middle of a geopolitical crisis? It won't. The cost of this short-term dollar funding skyrockets. The global movement of physical goods starts to slow down, not because of ships in the Persian Gulf, but because the financial plumbing that lets a buyer pay a seller has frozen solid. So, how does the liquidity freeze in the obscure world of trade finance impact your stock portfolio? It happens through a brutal process called forced selling. In a crisis, selling is no longer a choice, it's a requirement. Think about all the leveraged players in the market: hedge funds, institutional investors, and even retail traders on margin. When the value of their assets falls, they get the dreaded margin call. Their broker demands more cash. But where do they get cash in a liquidity crisis? Their credit lines have been pulled. They have only one option: sell assets. And what do they sell first? They sell what's liquid. They sell Apple. They sell the S&P 500. They sell Bitcoin. They sell whatever they can sell. This creates a terrifying feedback loop. The first wave of forced selling pushes prices down. This drop triggers the next wave of margin calls for another group of investors. They are also forced to sell, pushing prices even lower. In a liquidity event, price discovery disappears. A mechanical death spiral driven by a desperate, system-wide scramble for the one thing nobody can get: cash. In this environment, all correlations go to 1. The story behind your favorite company doesn't matter. Everything is treated as a source of liquidity, and everything gets sold. And remember, none of this requires a full-scale war, just enough uncertainty to freeze funding. Now imagine this scenario isn't contained. What if oil doesn't just spike, but resets higher? What if funding costs don't normalize quickly? Because in that world, the question isn't, will markets recover? It's, will you still be positioned when they do? In the next video, I'll show you how to position for liquidity stress before the market forces you to.